Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip discusses Berkshire Hathaway's investment in Goldman Sachs. My stock of the day in today's Value Engine morning briefing is Goldman Sachs and Warrants. Berkshire Hathaway has taken at least a $5 billion stake in Goldman Sachs as a bet that the U.S. financial system will stabilize. This is a preferred stock deal, which includes warrants to buy another $5 billion in Goldman's common stock. Goldman also plans to raise another $2.5 billion in a public stock offering. Goldman shares closed Tuesday at $125.05 in regular trading, then popped to $134.75 in the after hours. Why rush to give Hank Paulson $700 billion when a $5 billion investment by Buffett provides the credit market a buffer? Goldman Sachs is rated a hold according to ValueEngine.com with fair value at $166.65, so it appears that Warren's deal makes sense. The stock traded as low as $85.88 last Thursday before the Paulson rescue plan was announced. My monthly pivot has been a magnet at $138.62 after last Friday's high of $144.98. My opinion, trade the range, but don't own the stock longer term. If you want subscription information for the Value Engine morning briefing, send me an email, gmcreports@aol.com. My second blip discusses an alternative to the Paulson plan from an industry insider, tweaked slightly by yours truly. The mortgage assistance plan would give every homeowner with an income below $250,000 a $75,000 reduction of their primary resident mortgage. This money would go directly to the mortgage servicer. Homeowner would have to have lived in their home for at least 2 years. This would preclude any new homeowners that took advantage of the decline in property values from flipping to make a quick buck. The Democrats could call this their stimulus too, as it would probably cost $2 trillion or more in principal reductions of mortgage loans that qualify. This would free up consumer spending. The Treasury and Federal Reserve will watch toxic mortgage begin a detox program by actually getting some cash flow. Those that don't would be valued at zero. Tough luck for the investors in a dead security. To help pay for the program, we can rescind the Bush tax cuts and get out of Iraq. My third blip discusses the concept of too big to fail. After the Federal Reserve set up the primary dealer credit facility, I viewed that as saying that all primary dealers were considered too big to fail. This was obviously the perception in the credit markets as well. For reasons we may never know, the Treasury and the Federal Reserve thought it was wise to draw a line in the sand and let a 158-year Wall Street firm, Lehman, fail without allowing them the primary dealer lifeline. This bad decision resulted in the freezing of money market funds, resulting in the $50 billion bailout to guarantee million-dollar deposits in those funds. This is causing a drain of deposits in community and regional banks and likely contributed to the woes of AIG and another $85 billion bailout for taxpayers. The Federal Reserve should have been evaluating these toxic mortgage-backed securities for 6 months already. I suggested that they establish a mark-to-market by accepting them as collateral as a result of the Bear Stearns bailout. That's what a regulator is supposed to do. Regulate. This would have prevented what Bernanke describes as a fire sale price. Now Paulson wants to buy them for $700 billion. This talk by Bernanke of a fire sale price versus held-to-maturity price is a waste of taxpayers' money, and the Fed could have set standards for a mark-to-market well before last week's panic. To be quite honest, I still don't think that our regulators understand the depth of the financial problems we face in our country today. My fourth blip profiles Bank of America, which was downgraded today by ValueEngine.com. Bank of America is now rated a sell with fair value at $29.47, so the stock ended Tuesday 13% overvalued. The stock is trading up 3.4% in pre-market given the Buffett investment in Goldman. Investors should consider selling this stock on strength to the 200-day simple moving average at 35.37, as I expect the Friday's high at 39.50 to be the stock ceiling. B of A has exposures to loans that may not be covered by Paulson's rescue plan. Pre-Merrill, the bank has $1.78 trillion in asset, which makes it the largest bank in the United States. B of A also has the largest exposure to C&D loans at $42.6 billion of the $627 billion on the books of our nation's bank. They also created nearly $40 trillion in notional amount of derivative contracts. I cover Bank of America in my special report covering the Great Credit Crunch, which offers a better plan and a list of problem banks. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 and 4. Enjoy your day.